Historical risk and return introduces the foundational concepts of portfolio risk and return analysis within the program. Investors allocate capital among different asset classes with the objective of maximizing expected return while controlling acceptable levels of risk. Historical return data provide valuable information about how asset classes and portfolios have performed over time under varying economic conditions. By analyzing historical returns, investors can estimate average returns, volatility, and relationships among securities. Although historical performance does not guarantee future results, it serves as an important starting point for investment analysis and portfolio construction. Understanding the interaction between risk and return is essential because investors generally require higher expected returns as compensation for assuming greater uncertainty. The topic defines return as the gain or loss generated by an investment over a specified period, expressed as a percentage of the initial investment value. Investment returns consist of two major components: income and capital gains. Income may include dividends, interest payments, rental income, or other distributions received during the holding period. Capital gains occur when the market value of an investment increases over time. Historical returns can be calculated for individual securities, asset classes, or entire portfolios. Analysts often evaluate average historical returns over long periods to identify performance patterns and estimate future expectations. However, investors must recognize that economic conditions, inflation, and market structures evolve over time, limiting the predictive accuracy of historical data alone. Risk refers to uncertainty regarding future investment outcomes and the possibility that actual returns may differ from expectations. The topic emphasizes that investments with higher expected returns generally involve greater risk exposure. One of the most widely used measures of investment risk is variance or standard deviation, which quantifies the dispersion of returns around their average value. Higher standard deviation indicates greater volatility and uncertainty. Investors with lower risk tolerance may prefer more stable investments, even if expected returns are lower. Conversely, risk-tolerant investors may accept higher volatility in pursuit of superior returns. Understanding historical risk characteristics helps investors select investments aligned with their objectives, constraints, and overall portfolio strategies. The topic also discusses the relationship between asset classes and diversification. Different asset classes often respond differently to economic conditions, causing their returns to vary independently. Correlation measures the degree to which asset returns move together. Assets with low or negative correlation provide diversification benefits because losses in one investment may be offset by gains in another. Diversification reduces portfolio risk without necessarily sacrificing expected return. Historical return analysis therefore extends beyond individual securities to include relationships among investments within a portfolio. Investors use covariance and correlation measures to evaluate how combining different assets affects overall portfolio volatility and efficiency, forming the basis of modern portfolio theory and strategic asset allocation decisions. Historical risk and return analysis also highlights the differences among major asset classes such as equities, fixed income, cash equivalents, and alternative investments. Equities historically provide higher long-term average returns but also exhibit greater volatility. Bonds generally produce lower returns but offer more stable income and reduced risk. Cash investments provide liquidity and capital preservation but typically generate the lowest returns over time. Alternative investments such as private equity, hedge funds, and real assets may offer diversification benefits and unique return drivers. By studying historical performance patterns across asset classes, investors can better understand trade-offs among return potential, volatility, inflation protection, liquidity, and economic sensitivity within diversified portfolios. Overall, topic establishes the quantitative foundation for portfolio management and investment decision-making. Historical return analysis helps investors estimate expected returns, evaluate risk exposure, and understand the benefits of diversification across multiple asset classes. Measures such as average return, variance, standard deviation, covariance, and correlation are essential tools for constructing efficient portfolios aligned with investor objectives and risk tolerance. While historical data cannot predict future outcomes with certainty, they provide valuable insights into long-term investment behavior and market relationships. For CFA candidates, mastering the principles of historical risk and return analysis is critical because these concepts support more advanced topics in portfolio optimization, asset allocation, and risk management throughout the investment profession.